What's going on, everybody? Welcome back to another week of Wealth Webinar. Today is going to be an extra special show because today we're going to talk about case studies. We're going to talk about how this concept works. And we're going to talk about some advanced stuff and how Devin Burr uses this in his real estate empire that he's building to fund all of his deals, to take back all the money that he used to give away to everybody else, and to be in full control of every dollar of his money. Let's get into it, Devin. Show is yours, bud. You tell me what you want me to draw on the screen. I got my magic pencil and we will roll this thing.
Well, cool. Thanks for having me on, Chris. I appreciate it. It looks like behind you, we've got the example of how I do the Burr method with the policies, right?
Yep.
It's a little fuzzy on my screen, so I can't tell for sure.
We'll zoom in on it a little bit.
So yeah, guys, jumping right into it. What I do with my policies is first, I obviously put the money in the policy. That's the main thing, is funding the policy. So once the money goes in there, I do not let it sit. I immediately use it. So what I'm doing with my policy is really on a high level. I treat it like a bank. Obviously, banks, they make a spread on money, right? You put your money in the bank, they pay you a very small amount, but they still pay you. And then what they do is they take it and lend it out to other people. They keep the spread. That's at the simplest form what infinite banking is, keeping the spread instead of the bank making the spread. So all I do is I put the money in put the money in the policy. Then I immediately take it and I lend it to my business. So right there, I'm already making a spread. So it comes from my policy, goes into my personal bank account because it's a personally owned policy, has to go into a personal bank account. From there, I create a note from me, because it's in my personal name, to my business. And that note is where my business starts paying me back interest. So right there, I'm already making a spread. My business is paying me back with interest only. And I charge my business 15%. So if the insurance company charges 5% to use the money, I'm already making a 10% spread, not including what the policy makes. So if the policy earns 6% that year because of dividends, or 5% or whatever it is, that just adds to my spread. So hopefully that makes sense so far.
And if it doesn't, anybody, just chime into the chats. We're watching the chats as we're doing this. You know, if it's over anyone's head, we can address them as we go. But, you know, all we're talking about is the spread here. You know, the first spread was here, the difference between what his policy makes and what the insurance company charges him to use the money. And then the second spread is what he's actually charging his LLC. Now, Devin, real quick, because a lot of people would get hung up on that 15%. Like, why would you charge yourself 15%? Why not 3? Why not 5? Why not 8? Why 15? Where did that come from?
Great question. So again, you always want to treat your money like you would treat the bank's money. Before I actually started using infinite banking, I would pay hard money lenders 18% to borrow money. So from a business standpoint, it makes sense to charge less, or to pay less, right, than 18%. So I just chose 15% because it's less than 18 and it's still a good amount of interest coming to me. So it just has to be believable. If I ever got audited, I have a paper trail showing, hey, I used to pay 18%. Now I pay 15%. From a business standpoint, it makes sense. So you just have to look at what you usually pay on things. And that's what you would actually pay yourself back. I used to pay 18, so that's why I charge 15. So hopefully that makes sense to everyone so far. So the spread, again, we have the policy spreads about 1%. I lend it to my business from my personal bank account. So I just write a check, a personal check to my business. In the memo line, I just write working capital for real estate deals, loan for working capital, something along those lines. Again, just to give a paper trail in case I ever get audited, everything is by the book. So that check goes into my business bank account. From there, that's when I start using it for my deals. So what my business does is just monthly, I have a 15% payment going back to my policy. So if, let's say I lend $100,000, 15% of that is $15,000 a year. So that'd be what? $1,250 a month that would be going back to my policy. And the beautiful thing about that is that $1,250, as soon as it goes back into my policy, I can reuse it. What I do is I let it kind of build up and then I lend it to the business again. So essentially, I'm actually lending the same dollars over and over and over again. As I do that, I didn't even mention this, the 15% that I'm paying my business, or I'm sorry, that my business is paying back to me, that's a tax write-off. So I have 15% less that I can pay on my taxes. As it goes back into the policy and builds up and I lend it to myself again, I'm creating a bigger tax write-off. So I just have less taxable income. I have more money going back into my policy because I'm just recycling it all the way back through. Now, what I do as far as when the money hits the bank account, I go buy real estate, right? So if, let's say I have a deal that that requires X amount of dollars, I don't like to spend my own money, even if it's money from the policy, because the money from the policy is not actually my money. It's the insurance company's money. I don't like even using that. So what I do is I bring in private money lenders. So prime example, Colleen Brown, one of my lenders on a deal that I have. So I borrow money from her to do the actual renovation, the, buying furniture. I do Airbnbs. So to buy the furniture and furnish the property. And then I use the money from the policy to actually pay the private money interest payments. So everything that I'm actually paying to my private lenders is money that came from my policy. So I'm basically just leveraging other people's money, the insurance company, private money lenders, hard money lenders if I need to. And I just do it over and over again, recycle it back through. Now, once the project is actually done, so once I've renovated the property and I've increased its value, what I do is my LLC owns it. My LLC owns the property. What I do is I sell it to my wife. So my wife is actually the end buyer. The reason I do it that way is because if you do like a cash out refinance, so the part where the property is done, if I was to cash out and try to pay off private money, hard money, it's going to be kind of a crapshoot when it comes to the appraisal. The appraisal could come in like anywhere really. And then you have seasoning guidelines that you have to have and all that stuff. I know this because I used to do mortgages for 15 years. So to get around those things, I sell it to my wife. And with an appraisal on a purchase, it generally mirrors the actual purchase price because value is dictated on how much someone's willing to pay. So if I'm essentially the end buyer, my wife, we can dictate that end price so we can get all of the money back, private money lenders' money, hard money lenders' money, everything. So we have nothing in the deal. And then I just rinse and repeat. I do it over and over again. The money just flows through the policy every single time. So that way I can just get all the benefits, the tax-free growth, more money going into the policy. And yeah, it's a beautiful thing. So hopefully you guys have questions. I'd love to answer them.
All right. So now that we've got it up on the board, what are some of the questions coming in, Stephen? We got any coming?
Just kind of some technical stuff right now on policies, nothing on this specific topic.
But everybody understands what Devin's doing here. I mean, there's a lot of moving parts, but this is a very advanced strategy. What he used to do is borrow money from hard money lenders, like so many real estate investors do. He would basically borrow at a rate of 18. So a lot of times what that is that's the fixed rate plus points. Any of you that have borrowed from hard money lenders, you'll know that the lowest you're ever going to get away with is probably 8 to 9% plus 3 points in a lot of cases. So he was paying 18%. So it made more sense for him to take the money that he made, which obviously, some of you are like, well, where did that money come from? This is a question we always get, Devin, is they're always saying, well, where'd all the money come from that you put into the policy? Well, Devin saves almost all real estate investors have cash that they keep in the account, in their corporate accounts. And that cash then is used to fund his policy. Instead of leaving the cash in somebody else's bank, he just puts it in his own bank, which is the policy right here. And in a second, we'll talk about the spreads, because remember we talked about this is what the policy makes, and this is what the insurance company charges. Now, Devin knows he can get a lower borrow rate if he leveraged a bank into this mix with a cash value line of credit. But we're just keeping things very simple. 6 minus 5 would be a 1% spread. Then he makes the second spread here when he loans the money to his LLC, because the LLC is going to buy the real estate, loans at 15, which is better than 18 that he was paying to a hard money lender. So if he gets audited, and I'm sure he consulted with his CPA. So any of you that are looking at doing this, make sure you consult with your CPA to make sure all these numbers work for your situation. We can't give tax advice, legal advice, or investment advice. So check with your CPA. There, now I got the disclosures out. Here he's charging 15, which by all intents and purposes is lower than what he was paying. So that's justifiable. Lends that money to his LLC. His LLC then writes monthly checks for $1,250. Now, Devin, correct me if I'm wrong here. I'm kind of talking this through so everybody hears it, just a second time. This $1,250 a month, you're using some of that money to pay the hard money lenders that are lending on the rehab portion, correct?
Say that again. I'm sorry.
So this 15% that your LLC is putting back into this bank, I know you're continuously moving that back through at a rate of 15%, but are you using some of this money to support, if you need, because let's say you had 100 grand. Now I know for a fact you ain't buying any Airbnbs in Arizona for 100 grand. Just not happening today. So right. You might need, 200 or 300, but you might only have 100 in your policy. So you're lending 100 grand, but then you're borrowing the difference to finish the property. Is that what you were saying?
Correct.
Okay. Is this $1,250 supporting any of the hard money interest that you're paying?
Yes. Yeah. So all of the money that I take out from the policy is just paying for interest to hard money lenders and private money lenders. Okay,
perfect. So the full 100 is just paying for interest.
Yeah. So I'm not using that to buy any properties because you can't buy a 1-bedroom studio in Phoenix for 100 grand.
If you come to Buffalo, you can get a couple of those here. So anyway, right, so just so everybody's clear, a lot of people are like, well, if 100 grand isn't enough to buy the house, how are you doing this? A lot of people, they get in their head thinking that it's always about the resources. Folks, it's not about your actual resources. It's about how resourceful you can be. Devin is being incredibly resourceful, using his bank's money, 100 grand, to then be resourceful and go out and seek additional funds from private investors. But his bank in the activity here is helping pay for those. So that he has no money out of pocket outside of the original 100 grand that was sitting in his bank account. He changed where that money went. That money went into his policy where it's earning a much better uninterrupted compound interest, and he's moving that money back out. Now, the magic, I think, is right here and how he's moving this money continuously. Law number 2 of wealth is always make your money work for you. His money is never, ever, ever not working for him until the day he gets so sick of real estate and just says, I'm done. And that will be the day that his money needs to find somewhere else to go to work. But Devin has found a way to continuously move his money, make his money work for him with no interruptions. Literally, this money just goes around this circle and it's almost like printing money. I mean, if you ever look at how a bank operates, banks kind of just make money out of thin air. It's an arbitrage. It's a spread. That's all we're talking about. His money's always earning 2 spreads. It's making a spread 2 different times before he even gets into the real estate. Then the real estate part is really neat because then what he's doing is he's controlling end to end. He's not only controlling his money and how his money operates and works for him, he's controlling the assets that his money's buying, being this real estate. It's owned by his LLC, and then he just sells it to his wife. Now, you guys don't have to do that. It makes a ton of sense. I mean, being in the mortgage industry, this makes a lot of sense for them to do that. But for you, you might either just sell the property instead of keep it. You might cash it out and refi it like he did. But when he cashed it out down here, there was probably additional money that was made because he forced appreciation into the property through renovating it. And then I believe, Devin, this one you rented to your mom, didn't you?
One of them, yeah. I rented to my mom.
You've done numerous ones, but so he's renting this out. So he's got rental income. Plus, if the cash out refi was more than what he needed to pay off private investors and his policy, then basically he just takes that money and he just moves it right back over here. And then he finds a way to move it back out. I mean, think about that. It's end to end. You know, when you look at Steve Jobs, not to go tech on you, but we started with tech. We're going to finish with tech here. Steve Jobs set out to control his technology end to end. No interruptions in between, no other parts in there. He wanted control. Devin, in this case study, is all about end to end control. There's not one thing in this process that he's not in control. He's in control of everything. And all of you need to really look at your scenario and say, are you in full control of every piece of your money flow? The answer is almost always no. I mean, very, very few people are in control. I'm going to turn this over back to you, Devin. You want to get a little bit into the numbers?
You hit it on the head. The biggest thing that I focus on is control. I think if you don't have control, you have heightened risk. Think about a car. If the brakes go out, your risk of stopping or your ability to stop, you don't have it. So your risk of crashing goes up. Same kind of thing with real estate. If you don't have control, your risk of losing money goes up. So I just try to have control of every single aspect of a transaction so that my risk is very, very, very low. And the coolest thing I think about it is the only money I actually have in this deal and any deal is the 5% I pay to the insurance company. So on something like this, if it's $100,000 and I'm paying 5%, that's $5,000 in a year. If it takes me 6 months, I've only got $2,500 in a deal technically. And let's say if I was to flip that property and make 50 grand, that cash on cash return is ridiculous. So it's a cool thing when you really understand these policies and how to use them, you can make just ridiculous returns. I see there's actually a lot of questions in the chat.
Yeah,
so
yeah, there's a bunch coming in now.
Cool. Well, let's address some of them, because before we get through this concept and go to the next part of it, which a lot of what we're going to really drive home today. So first, you've got the concept. We got to make sure you all understand this first. After the concept, we're going to get down in the weeds a little bit, and we're going to talk about the one thing everybody wants to talk about, because nobody can get their head out of just the whole life policy. Well, the whole life, let's go back to the whole life. People, when we talk to them, and I'm just going to kind of nail this one on the head, Devin and Steven, you guys can comment. Maureen too, you probably deal with this. Everybody is familiar with a whole life. So everybody just wants to talk about the whole life. The way we look at the whole life is nothing more than a machine. Literally, it's like any other machine. Something goes into it and it spits something else out the other end. Okay. Your car, you put fuel in it and it turns it into energy so your car can go. All it does is moves your money. This stupid whole life that we always put so much emphasis on is nothing more than the most efficient conduit you can use to run money through. This is not the most important thing. If all of you get excited about the whole life and the 6% Devin's making here with dividend, and the 1% spread he makes, from dividend or from his earnings to what it costs to borrow the money, you're looking at this all wrong. Devin loves this because you can't even make 1% in a bank account that you're not in control of. So he has a better way to make money right in the beginning. And we're going to talk about the years after the first year, second, third, fourth. And that's going to blow your mind because the spread is not 1%. Everybody wants to be short focused and short thinking. This is the first year. By the third, fourth, fifth, sixth year, his spread is in the double digits, folks. Welcome to uninterrupted compound interest. But again, this is just the first place. The real money he's making is all over here, none of which has anything to do with this whole life, except for the whole life allowed him to make money one more time without working harder, without working longer, and without having to take on any additional risk in what he does. Zero. If that doesn't resonate with you, then we missed something. We got to take a step back. So put a question in. This is just the first step. What we do with the money and what Devin did with the money is single-handedly the most important part, which is what is called the infinite banking concept. The infinite banking concept, for all of you listening, is nothing more than the process Devin just explained to you. It is the process of what his money did. He took back the banking functions in his life. Exactly what he used to give up to a hard money lender and to traditional banks, he just took it back. That's all he did. Nothing more, nothing less. And in doing that, he makes a stupid amount of money. That's it. That is the equation, the secret formula for building wealth. And again, it's not fast, it's a slow build, but that is the secret formula. Because when your money's working for you and in your control, nothing else can happen than this. So Stephen, let's hit some of the questions we got.
Yeah. So when you're taking the loan from the policy of 10K, you pay the 10K back with 15% interest. The insurance company gets 5 of that. So that extra 10% interest, they're saying, how do you get that into the policy without mecking it? So what do we do with that 10%?
Great question. So it's really quite simple. Like if I take money out of the policy, let's say it's $100,000 and I'm putting back in $1,250 a month, I would never mech the policy unless I paid off that entire 100 grand and then put an additional 1,250 in. So as long as you're continuing to borrow from the policy, when you're putting in the money, you're just repaying the loan. So you're just lowering that balance. As long as you just keep borrowing, you're never going to mech the policy. The problem would be is if I paid off the 100 grand and then kept putting 1,250 in without borrowing again, then it would mech. So hopefully that makes sense.
That was, well, there's no better way to explain it.
Yeah. And then once you have enough in your segregated account built up that it can't go back into the policy, then that's when we open up an additional policy to build the banking system.
Yeah. How many do you have now, Devin?
Just opened my 9th.
You're already at 9, you son of a bitch. Listen, folks,
I'm
I've
on
been
number
doing
5.
this. How many are you at, Maureen?
5.
5? Holy crap, I'm going too slow here. I've got 9, but I've been at this for a while, folks. Devin hasn't been at this half the time that I am, and he's already at 9. I had no idea, you dirty devil, you. Anyway.
A year and 9 months.
Yeah, well, I've been doing this a lot longer and I only have 9. All right. So, but anyway, like that answer to that question is how Devin said it. But the reason he has 9 is partly because this $10,000 from, what he's paying his segregated bank back to the 5,000, he's continuously just moving it. Remember here, I drew the arrows, like his money's just moving from segregated account to LLC, segregated to LLC. But when he sells the house and he doesn't need this money to keep moving, then he's going to have a problem, which is going to mean he's going to need another conduit for more money. Because when we build the policies, his policy is built for 125,000. That's it. He can put no more money than 125. So as soon as he exceeds 125, his only thing he can do is the same thing that every bank in the world does: open a second branch, a third branch, a fourth branch. And each branch is a policy. That's all there is to it. What else we got, Stephen?
And just to clarify, because I answered this a second ago, but just to make sure everyone got that, I can put in more than 125 as long as I'm taking loans. So I can't put 125, take no loans, and put more in. I can put 125 in, take loans, and then feed more into the policy, take more loans, feed more into the policy. As long as you're taking loans out, you can put an infinite amount of money into a policy. You just got to keep borrowing from it. So you just got to keep moving the money.
Yeah. And I mean, like this is real estate. Imagine if you did this for cars. We got a client, Devin, I'm not sure if you know him, but he's super big into the car thing. He does Turos. And I never heard about it until this guy said it. I think he's on his 3rd or 4th policy. Stephen, you may have even helped him with one of his policies. And all he does with his policy is what Devin does with houses: just replace the house with a car. He's just buying cars, and then he goes on Turo and he's posting the car up on Turo. So his car is literally out there working for him every day, and his policy, his bank, paid for his car. So, I mean, how many different ways can, the 138 people that are on here think of to basically move money? Some people think of cars. Devin's doing real estate. Some people are like, well, I can't really do any of that. I got a lot of debt. Great. We add debt over there. We pay all the debt off this way. There's so many ways to do this that it's infinite. And that's why it's called the infinite banking concept. That's right, Cynthia. Rinse and repeat. That's all we're doing here. What else we got?
Yeah. So when it comes to the interest you're collecting on your personal taxes, isn't the amount of interest basically a wash when you combine your LLC with your personal taxes?
Devin, you want to hit that? I mean, you're getting dinged on taxes on this. He's not avoiding the tax man on this one.
Yeah. I mean, I leave that up to the CPA,
Yeah.
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 So
He's going to get hit a little bit on the spread here. where he's going to owe some taxes. And, listen, for anyone that's trying to completely avoid paying taxes, we hear it all the time. You're not trying hard enough. Anybody that is wealthy or anybody that's moving money, we look at taxes in a different way. Like, we're happy to pay them, but we're going to try to eliminate as much of that tax burden through deductions over in the LLC side. But yeah, I mean, in a scenario like this, or like how I'm using it with private lending, I'm paying taxes on the interest that I'm taking back. He's kind of fortunate here because he's got 15% as a write-off, because that's a cost to his LLC. And then he's got a cost of, let's just say 5, but he's going to get dinged somewhere in this whole process. But the thing
and
is,
that 5 is actually a write-off as well. So the money that's paid to the insurance company,
yep.
I write that off as well. So just to put it in perspective, guys, like this last year, my taxable income with my LLC is laughable. It's like $8,200. And I think the LLC brought in like 5 million. So the amount of write-offs that I have is crazy. And a lot of it just comes from continuously loaning money to the LLC from the policy, and then putting it back into the policy, letting it build up and lending it again. So that's a huge tax hack. I'm going to have to pay some sort of taxes on it on my personal taxes, but I don't know. I leave it up to the CPA. It hurts my head to think about it sometimes.
I'm going to pull up something else here, Devin, real quick. Steven, as I'm looking for these documents, do you want to hit some more questions real quick?
Yep. If I want to set up a business LLC specifically for private lending, are there any specific considerations to avoid any additional regulation scrutiny? I mean, I would just talk with, well, you don't need to have a LLC set up for private lending, but if you do want to set that up and make a business out of it, just, whoever your attorney is or whoever's setting up the LLC for you, just make sure it's done properly. Brent Carlson, Corporate Capital, I'd recommend to help you with that, which we can put their info if you want to, just let me know. Let's see. Michelle is asking, how do I get about setting up this type of policy? Do I need to go to a specific company or just state? Yeah, Michelle. So these are very specifically designed and engineered. That's what we do. All 4 of us, I guess. That's what the Money Multiplier does every single day. So we'll post a link in the chat box, and all you need to do is schedule a call with our team, and we will answer all your questions and help you get that designed. Because if you call your local agent or somebody or even the insurance company directly, I can promise you it will not be set up properly. So make sure you don't do that. That happens quite often to people, unfortunately. So make sure that you are talking with a certified infinite banking practitioner. And if you want to work with us, I'll post the link.
Any other questions?
Yep. So does your wife buy the house with conventional financing?
Yes. So my wife actually works for Quicken Loans. So we just do the loan through her company. So we use her W-2 income and just keep it all in house. So we do 30-year mortgages. Obviously with interest rates, the debt service is really low. So we're making a good spread on the cash flow, and we can get to, I know this question is going to come up because it always does. Under her personal name, we can have 10 properties. Once we get to 10, that's the limit. We have to bundle them into a portfolio loan, and then we can rinse and repeat and do 10 more. I always get that question, so I want to just nip it in the bud and answer it now. 10 is the limit. Once we get there, bundle it into a portfolio and then do 10 more.
When you sell to your wife, how is it that done on a tax side? Are you filing taxes as joint?
I believe we do file married joint. What I do on the deal itself is I bake into my tax liability. So if, let's say we got to pay back hard money, private money, and all that stuff, I also look at how much am I going to get taxed on selling it to my wife, because it will be short-term capital gains. So I just look at that and then hold that back in the equation. So we're always baking that into the numbers so that I'm not, what's the saying? Stuck holding my pants. Is that the saying? When it comes IRS time.
That's one of the sayings. I've heard many.
Another real technical with you and your wife, I don't know if you want to answer it. I'm assuming that your wife is not associated with your LLC that owns the property. Does she buy it as an individual or through another LLC for investment purposes? If through an LLC, are you associated with that LLC?
Great question. Okay, so she is not involved with the LLC that owns the properties. So it's sole member LLC, which is me, buys the property, does all the renovating and everything, and then she comes in and just buys it as an individual. We've done this several times. There's been no issues selling it to her since she's not on the LLC. We did run into an issue recently when we were trying to do a jumbo loan. So as a jumbo loan, not conforming, there was an issue selling to her. So we had to get creative and actually, I had to write the rights of the property over to a business partner so that their LLC owned it, and then she could buy it from that LLC. So if you guys are going to do this strategy, if it's a jumbo loan, you're probably going to run into issues. So just make sure that you adjust for that. But yeah, that's how we do it. She's not on the LLC and she just buys it individually. And then after the fact, we actually quit claim our holding company onto title. And that's held through our trust, which don't even get me started on that because I have no idea how it works. My lawyer does all that stuff.
All right. Let's see. Let them know today. So just so I understand, Devin always takes separate individual loans from his policy from the insurance company for each person he borrows from. He never groups them. For example, one loan for two lenders.
Devin, I think what Jill's asking is the loans for your policy. She's asking, are you, I think, and Jill, if it's different, correct us. But you're talking about when Devin's taking loans from his policy and how that applies to the private lenders. Because the way I understand it, Devin, is this is just a revolving door here. It's 100 grand in circulation, which pays all your private lenders. So it's your money and your policy pooled together. And if you need more, as you keep funding your policies, you just keep taking more and put it into this mix, correct?
Correct.
So Jill, if it's a different way you're asking, just tell us and we'll try to hit that a little bit better for you. And he's not in doing that, just so everybody's clear. That question kind of would insinuate that you're commingling funds, but he's really not, because his funds are just serving as operating capital for his LLC. So it's not commingling anything. It's just his funds from his bank are the operating capital that allow him to borrow, do the renovations. And he's doing some crazy Airbnbs in Arizona that we were just out there. I mean, they're beautiful. So these are high-end properties that he's doing, and his money's just feeding his company. I mean, every company needs money, right? How many of you on here are business owners? Say aye in the chat. So as you guys chime in that you're a business owner, think about your business. How often have you needed capital to operate your business? Most businesses are capital suckers, if you ask me. They just love taking cash flow. And anytime you need cash flow in a traditional sense, where do you go? Well, all of you rush over to your traditional bank that you think you've got this great relationship with because they give you dumb suckers every time you walk in the door and maybe shitty coffee. But when you go into the bank, you get yourself a line of credit, right? And then who's charging interest on that line of credit? The traditional bank. And you gladly pay it because you needed working capital for your company. Devin, mine, Maureen's, Steven's, anybody on this team and anyone that we help, we just no longer need the bank's line of credit. The only way we're going to use a line of credit from a traditional bank is to reduce this, our borrow costs. And how we're going to do that is banks love whole life insurance. They're the number one purchasers of whole life in the world. I can't remember the exact number. I think $75 billion is how much, as of 2021, banks, just the top banks, owned in whole life. So if they're buying whole life, do you think they want to lend with whole life being the collateral? Of course, to the tune of about 3 to 3.25%. So that's the only way we're ever using a bank, is we're leveraging our policy to get a lower borrow rate than the insurance company. That's it.
So dense information, a chance we can see this again? Yes, absolutely. There's a replay will be available by Monday, Chris, on the YouTube channel. So go to YouTube at the Chris Naugle, and we put all the replays right on there, and it should get emailed out to you as well.
Yeah. So if you guys want replays for this, the best place to get them is my YouTube channel. We're going to email them out just because you registered, but go to the YouTube channel. There's so much new content that we're developing for YouTube. And I mean, when I say content, I mean very relevant content like that video you were watching before we started. So subscribe to the YouTube channel. It's just the Chris Naugle, and click the alerts button so that you then are notified every time we put up a new video, and you'll never miss one. You can just watch them on your own.
So what do you do with the money after you do the last refinance sale? Are you just getting new policies?
Yeah, if there's money that we get out of the equity, a lot of times with this, what's the word I'm looking for? With this technique, I guess, we don't get a lot of money out of the equity because my wife has to bring a down payment, usually 20%, and that goes to the lender. We don't want to have any money in the deal. So 20% of my proceeds are going to go back to her. So I'm going to pay her back her down payment. If we buy $1 million property, that's 200 grand. So that'll be 200 grand of my proceeds right off of the bat going to her. Then we're going to pay back private money, pay back hard money, and we don't have anything left in the deal usually. Very seldomly do we actually get money back. And if that's the case, I'm going to either start a new policy, or I'm just going to take that money and put it back into an existing policy. So hopefully that answers the question. But anytime I have new money and I can't put it into an existing policy, I'm getting a new policy.
Also.
All right. Being a stay-at-home mom, my husband was the only one working. Now that we are in the middle of a divorce, I will be receiving half of his retirement money. Are we in the process of completing the QDROs? If I put this money in a whole life, I won't have to pay taxes on it, or are taxes deducted before they pay me?
I can take that one. So you're talking about a quadro, which is qualified, it's a couple of years, qualified distribution or divorce. Oh God, my God, I used to be able to recite that. Anyway, it's
I forget what the
quadro.
acronym is.
I used to be able to rattle that thing off.
Yeah.
But, I retired from Wall Street in 2018. Holy shit, and I'm forgetting it. But anyway, that money that's coming is from his retirement accounts. Chances are, if you take that as a payout in cash, you're going to owe taxes on that money. And depending on the amount of the quadro and in the distribution, it could be substantial. A lot of times, a smarter play for you with that quadro money would be to move it into a self-directed IRA. Another thing that we can help you with, because if you do kind of just say, all right, just give me cash, I don't want it going into a retirement account, you're going to get hit by the tax man. And you know what? You might look at that and say, hey, Chris, that's fine. Like, I'm probably never going to be at a lower tax bracket than I'm at today. So let me pay the taxes now so that I can enjoy tax-free money the rest of my life. If that's what side of the fence you're on, and you've consulted with your CPA that that's a good move for you, then definitely take that quadro, pay the taxes, rip the Band-Aid off, and put that money into this tax-free environment for the rest of your life. But if you don't want to pay taxes, the only option would be, I'd suggest moving it into a self-directed IRA. And then it's a similar process because you can do the same things with a self-directed, except for you're going to miss out on the uninterrupted compound interest component. I'm pissed that I forgot what quadro stands for. Qualified domestic.
Google it. Should Austin pay off his house before starting getting Airbnbs like Devin?
I don't think so.
No,
I don't think so. I mean, you look at interest rates right now, most people are at like sub 3%. Think about the government. What the government does is they print money with a T-bill, and that's debt for the government. They pay that debt back as slowly as possible with devalued dollars. You should basically treat your debt the exact same way. Pay it back as slowly as you can with money that is being devalued. Take your money that's today the most valuable and go make more money with it. Unless it's a super high interest debt, but mortgages are super low debt, interest debt, and they have advantages. Like you can write off the interest on the mortgage. So I wouldn't worry about paying your mortgage off. Even if you pay a ton extra, it's going to take you several years and you might miss the boat on, getting into Airbnbs. So I would say just, really do your homework, study up. So that way, you know exactly what you're doing. And when you get into it, it's not a big risk because you already know what you're doing. And partnering with people is good as well.
What do you think the long-term outlook on Airbnbs is going to be? You think it'll be a strategy for years to come, or you think things are going to change in that industry?
I think it's going to be around for a long time. I see mostly everything being service-based. I mean, it's going to probably get to a point where, cars are all electric and you can just click a button and a car comes and picks you up. There's no one actually driving it. So Airbnb is service-based. So as values go up, homeowners can't really afford to buy a house, so they have to rent. So that's why I really am big on owning everything, because as more people have to rent, that just means that I'm good. I'm going to have more cash flow. So as an Airbnb model, I think it's going to be around for a long time because it's service based. In my opinion, it might even get to a point where people want to live in different houses all the time. So they just rent an Airbnb for the entire month. And then, okay, let me rent another house because that's all I can do. I can't buy a house right now. So I think Airbnb is going to be around for a very, very long time. And if it's not, I mean, might as well get in right now while it's hot.
No, I love it, man. I love staying at them. I love the whole idea and concept of it, and other people being able to own them and control them and manage them. I think everything's awesome about them. And if you just look at the overall costs of everything right now and how it's hard, people aren't working. I mean, hotels are expensive as hell too. The service is no longer there. I mean, the last like half a dozen hotels I stayed in, they don't even give you room service anymore because of COVID, like everything else. So it's crazy, man. So I love it. I think it's a great strategy.
It's a sick excuse that we're dealing with. I mean, I stay at nice hotels and they don't even come in and clean the damn room. If I want an extra towel or I run out of shampoo, I got to call down and wait. It's a whole different world. So Airbnbs kind of put you in that homely feeling. I love them. I agree. I don't think they're going anywhere anytime soon. I really don't.
Yeah,
all right. So Alan's asking,
we excel at them too because, sorry about that, Stephen, but I was just going to say we excel at them because my wife works at Quicken. I used to work there as well. They're a company that is huge on client service. Like if you didn't return a phone call within 24 hours, you could literally lose your job. So client service was huge. So that translates over to our Airbnbs is like with Airbnb, you want it to be an experience. The better experience you can give people, you're going to get 5-star reviews. The more 5-star reviews you have, you become super host and you can start charging more because you have a well-performing property. So it's all about client service. It's all about the experience. I think that we're suited well for it. So if you guys are big on that as well, client service, I think that Airbnb would be good.
Donna says, am I the only one worried about hidden cameras? Donna said.
Oh, wow.
Oh boy.
All right. So you might have already hit this. This was like 15 minutes ago. You asked this question, but explain the part about your wife's participation. And is this a close financial loop? From where is her money coming from?
So her money is coming from her employment. So she is W-2'd. So I'm lucky to have a wife that busts her ass. Like she does very, very well as a W-2 employee. So we qualify for the loans all day because we don't have a lot of consumer debt. We have no car loans. I buy all my cars through my policies. We've got no credit card debt. We pay it off with policies every month. So yeah, our debt to income ratio is low. All of that comes from her end. So her money's her money. And then as far as the closed loop, what was the part of that question?
I think it was just part of that. Like, are you guys kind of doing this together or if it's separate? I don't fully know.
Yeah, I mean, it's together because at the end of the day, we're in a community property state in Arizona. So her money is my money. My money is her money, but she qualifies on her own through her W-2 income. So hopefully that answers that.
Yeah, I've done that with my wife before where we've qualified separate on properties just because it was easier to do it that way for various reasons, but it works fine. So should I be charging my LLC interest on the money I loan that makes interest?
I don't know why you wouldn't. I mean, I don't charge my LLC. I just did it again just the other day. I charge my LLC 6%. And I do that because I used to pay 9% actually on a LLC or a line of credit with Key Bank. So I no longer use Key Bank's line of credit. I just use my policy and I charge 6%, which saves my company money. He's doing the same thing, 18 versus 15. I don't know why, you always, when you're looking at this, David, you got to think of this in this one general statement. You got to treat your money the same way you treat the bank's money. If you borrowed money if your LLC borrowed money from the bank, would you ever not pay them back with interest? You wouldn't even think of not paying them back. You'd go to the end of well, you'd go pretty far. I don't want to say the end of the world to pay them back because you don't want your credit to get destroyed. You don't want the threatening letters. You don't want the calls. You'd pay them every single month, even if it's just a minimum payment. So if you change your mindset and you are the bank, why would you ever not pay your bank back with interest? Because you would never be able to borrow money from their bank and not pay them with interest. So it's kind of just, I don't know, Devin, I don't even think about it anymore. I'm so
I
deep
don't.
down this rabbit hole. It's just like, I don't even understand how people, a lot of people will come on and they'll say, oh, well, why, if we don't have to pay the loan back, why would we pay the loan back? I want to go over to the wall and start banging my head on it because I can't even think like that anymore. That's stealing from your bank. This is our bank. This is Devin's bank. Our policies are our banks. Why would he ever not want to pay our bank back? It's our money. It's our profit. It's our interest we earn. Like, what part of that would you want to skip? And if you do, well, you're just not a good banker and you should just keep doing things the way you do now, or go one step further and really start to understand this is not complicated. You're literally just doing exactly what you're doing today, except for the bank has your name on it. That's it.
Yeah. I always tell people that it's like, if you don't pay yourself back with interest, you don't have to. Like, there's literally no one telling you have to pay the loan back. But if you don't, it's like you're saying that the bank's money is more valuable than your money, which is asinine, right? Like, if you're going to make a payment to the bank without fail on time, because if you don't, they're going to be calling you nonstop. They're going to be dinging your credit. So you make sure to pay them. But you should do the exact same thing with your money. And I can tell you this from experience. I've made payments to other people before, whether it be a car loan, whether it be a personal loan. It sucks. But making payments to myself is awesome. Like, literally, I look forward to the day. I have every one of my payments scheduled for the first of the month. And if I could share my calendar, you guys would see, like, on the first, I've got like this big on the calendar, just reminders every month of how much to pay myself. That is awesome. I grab this checkbook right here and I just start writing checks to myself. Much better than writing a check to Wells Fargo or, Chase Bank. Writing a check to Devin Burr is awesome.
Damn, man, I just got so excited hearing that. It's like, I'm sorry, but like, I do it a little different. I don't write checks. I set them up on bill pay. I'm just too busy to write checks anymore. So what I do, and I just did one, like, I'll make a loan to someone, or I'll make a loan, and the bill pay will come in a little check. And I talk about this all the time, but for those of you that are new to this, how many of you have ever gotten a bill pay check from the bank? I can tell you exactly how they operate. There's two little creases you make on each end of it. You tear it off. There's one across the top. You tear the top one off. The check folds down. Now you see it. Ooh, $378. Okay. You rip the top piece off, and then there's a little trick, and I always make sure I do this. You don't have to, but I do. There's an additional crease. You fold it, and you just tear that other one off. So now you got yourself a nice clean check. And I just write my deposit slip, put it in the bin. I don't even go to the bank anymore. I just go to the drive-thrus, the little bins that you drop it in, and I drop them in. I literally get so freaking excited. My entire staff here has been trained. When they go and get the mail, those bill pay checks go on the very top. All the rest of them, the bills and that, put those on Shauna's desk. Put the checks on my desk. And I go through the process. Don't call me. I don't answer emails. I don't look at my phone. And I tear those little edges off. And that's, man, I don't know. That's like whatever your thing is that you guys get excited about. That's my thing. The more of those little checks I can have, the better my day gets. And every single day, I just want more of those checks showing up. And all I need to do to get more of those checks is just keep moving this stupid money around this circle and just do it over and over. And that involves loaning money to my LLCs. That involves paying for cars. That involves, buying copy machines. Shit is fun. Somebody's got to do a rap song about that.
That's why I like getting on these. I like getting on these because I always learned something. I did not know that I could do a bill pay to myself.
The bank will send that check to anybody. I don't know what you're doing writing checks, man.
That's incredible. You just saved me every first of the month. You might have just saved me at least 15 minutes.
Yep. I'll send you the bill. All right. What other questions do we got coming in?
Are you only buying in Arizona or doing it out of state?
As of right now, yeah, just Arizona. I'm born and raised here. I know it like the back of my hand. I am a firm believer when you get into real estate, start in your backyard. Start where you really know the market. I've only been doing real estate for just at 2 years. My first property I bought was January 13th of 2020. So I'm not super experienced. I think eventually I'll start looking out of state, but as of right now, yeah, just Arizona. I've done a few wholesale deals in different states, but it was a nightmare. So as of right now, just AZ.
So if somebody has an existing car loan, like not buying a new car, does it make sense to pay off the loan using the policy and then recycling and recapturing it back to himself instead of continuing to pay TD Bank where it's currently at?
I'll take it.
I think it's because it would depend on the interest rate, really. Like if it's a super low interest rate, there's better uses for the policy. Like you could do it, but if it's a low interest rate, you could just there's better uses for that money. If it's a high interest rate, let's say I don't know 6%, then remember it's all about the spread. You always want to think about a policy as what can I do to make a spread with this money. So if you have a 6% interest rate you're paying off, and it costs you 5% to borrow the money, you're making a 1% spread plus what it's making in the policy. So if it makes a 1% spread in the policy, you're making a 2% spread. So that's not bad. But you could do other things and make a bigger spread. So it really just depends on the interest rate, in my opinion. What do you think, Chris?
That was Peter. I gotta comment on that because I've been kind of going another layer deep. You know, both of my cars are mine and my wife's are funded through our policy. And it's fun. I have a ton of fun when I buy a car. I don't look at a car purchase the same way that most people do. I don't go in and try to like beat down the price of the car. I do negotiate it, but really what I'm doing is playing a game of how much can I get this car for monthly? But most people buy cars on a monthly payment anyway. I do that. I go in. The last one, you know, that we did was Larissa's Mercedes. I went in, I just went back and forth, back and forth. What is the lowest monthly payment that we can get on the car? They give that number to you and they say, okay, we're ready to go. You know, I didn't really beat up on the price of the car, but the price comes down on the car as you come down in the monthly payment. Once they arrive at that monthly payment, all I saw in my mind when they slid that paper over with the monthly payment, that's how much money I got to pay my bank back every month. And I do that. But we're going to be doing a case study. It's a brand new client that's just came on to the Money Multiplier. I've been working with her for a while. And she has, so I'm just going to use Peter's example because it's so dead on. She has a car that has slightly more than $50,000 that is owed on the car. It's a GM, but she has a 0% interest rate. And her payment is about 800, I can't remember the number, but let's say it's $816 a month. So those are her metrics. So now in her policy, she's got a little over 100 grand. So we'll just write 100K in her policy. Now that 100K, I want to be clear, just came from money that was sitting around. It was just in a bank account, you know, it was her emergency fund, her, you know, I don't know, whatever she calls the money, bus fund, some people call it. So she said, all right, well, what can I do? Should I take the money from the policy and pay the car loan off, take the $816 and put it back in the policy? Right off the bat, that doesn't sound like a bad idea because, hey, I'm making a spread 6 minus 5 or whatever the spread is. And we're going to get into that. I promise before we're done, we're going to show you those spreads, you know, and do that. You can make that a little bit, but you still got to look at it and say 0%, kind of like Devin, what he just said. By paying that car off, you're admitting to yourself that you can't do better than 0% on your money. You can't make your money go to work at a better rate than 0 because I can. So here's what we're going to do. And I just worked with her on this and I'm so freaking excited. We're going to take this money and we're going to lend this money out at 12%. We already know where it's going to go. So we're going to take this and we're going to lend it out on a real estate deal like Duck V's. Okay, Duck V's on here. He's got a deal right now that he's paying 12% on a real estate deal secured in first position. So she's going to take the loan for, I think it comes out to be about $86,000. Okay, she's going to take a loan for 86 grand and lend it out at 12. And don't beat me up on the numbers, folks. I'm guessing. This 12% interest that this loan is going to pay her will be sufficient to pay for her car. We did it all, the math. 86,000 or change is enough to give her $816 lending it out at 12%. She then will pay the car totally off, okay? That car will be paid off. Her money was earning her 12%, so her money working for her paid her car payment. So instead of us saying, you know, oh, we get all the money back for all the cars we ever buy, drive, and own, what she's doing is 2 steps deeper. She's having her money go to work in a real estate deal, a loaning, you know, lending deal. The lending deal pays the 816, fully pays off the car in the same time frame that, you know, the car would have normally been paid off at 0% interest. Then when she's done with the car payment, all she's going to do is keep that money working. Now, $816 a month is going to be coming back over to her policy. and then start regenerating and recapturing the 86 grand that's out there working. And every time it comes back, all $816 of it, she's basically, she just got to send that money back out to work. So it's just another way of looking at it. If you got a car that is a really low interest rate, let's not pay the car off. Let's not pay the house off because rates are so low. Let's enjoy this low interest rate environment because it's going to be over after this year. Just so you know, the Fed is going to raise rates 7 times. They said 7. This day is that's going to be gone. But while it's here, let's do that. And let's just have our money work harder and then have that come down here and pay for our cars, pay whatever you guys want it to pay for. That is awesome. And we will be doing a case study of exactly how that thing pencils out and works so that you guys can, mimic and duplicate it.
Yeah, it's really cool, actually. If you guys study any people like Robert Kiyosaki, I'm huge on Kiyosaki. I think he's a genius. He always talks about not using earned income to buy things. Use your earned income to invest in things and then buy the things you want with the money that investment brings in. That's basically what this is, right? Instead of you're using your money to go make an arbitrage, right? A spread. You're making 12%. That 12% pays the car off. So you have assets paying for your liabilities instead of earned income paying for the liabilities. So that's genius. I love that right there.
Yeah, we teach that a lot in our 3-day Money School Essentials virtual training that we do. We talk about it. It's the first thing I learned when I got into real estate investing. If you want to know how many houses you need as rentals, just decide how many expenses do you have and then buy rentals for that. I mean, so that way, let's say I have an $800 car payment. Well, I need to buy a duplex that's bringing in $800 a month. That's now paying for my car. I want to get a boat. I now need to get enough doors to make a $1,500 a month boat payment so I can buy a boat. And just however many expenses you have, buy those houses that pay for it, or assets or cars or whatever that is. But
the hair on my arm just stood up, Stephen. When you started counting more and more properties, I just started thinking of all the headaches that comes with. I like this lending.
Yeah.
Devin's laughing because he knows.
Peter was asking, so if you want to tell
easy,
Peter how he can get involved.
What was it?
Peter was just asking that. How do I get involved with lending at 12%? So,
oh gosh. Well, I mean, Private Money Club, of course. I mean, Duck V, who's on here right now, has a deal on Private Money Club. I think he's got some room left on it. Last I knew, he had like 300,000 left he was raising. He's paying 12%. I just filled on Private Money Club. Literally, this is just show you the power of Private Money Club. It's a blessing and also a curse at the same time. I put a Chris Rude deal up on there when was it? Yesterday I posted it. We had 125,000 Chris Rude was raising at 12%. Now everybody knows Chris Rude's deals are gold. He pays them off quick. He's never really late on payments. He's just got it down to a science. Within, 15 minutes, the deal was fully funded. And I could not keep up with the amount of DMs that were coming in. Hey, is there any room left? And I felt bad. I had to say, I'm sorry, there's not. Because, and one thing people love about Chris Rude's deals is you can come in at amounts like 20 grand, where the deals like the Atlanta development deal that we just did with Rob Fuller, that's 12%, but you got to come in at 100 grand. Duck V's, is 50 grand. So, the lower investment ones, we're going to be answering that very soon. We're creating another debt fund that's going to be lending on real estate that is going to pay between 6.5% to 10. And you're going to be able to come in with as low as 20 grand. That's going to be brand new. We just haven't announced it yet.
We got deals on there right now, 5 years, 10% annually for a 10,000 minimum. I mean,
Dwight's
there's
deal.
everything on.
Yeah. So that's Dwight's deal, right?
Correct. Yep.
Yeah.
So we got a lot of price ranges anywhere from 10,000 to, $500,000 or more you could do, and anything from 6 to 15% right now.
Exactly. So, you just got to get in Private Money Club. I mean, if that's an area that you think interests you, then that's where you got to go. So what I'm going to do, Devin, is I'm going to switch this over. And Maureen, actually, do you have a calculator by chance? Awesome. Can you play along with us on this? Because I'm going to do this the old school way, because I want people not to just look at the number. I don't want to just give it to them. I want them to actually have to think about this, because we sometimes give everything to you and make it too easy. And then when we do that, people are like, well, how'd you come up with that? A calculator. So we're just going to do it the old way. Is that fair enough for everybody? Can we just kind of go back to the old school way that we calculate things? So Devin, I'm going to put your policy up on the screen. I want to be very clear, folks. What I'm going to show you on the screen here is an actual policy. This is actually Devin's policy, and I'll make it bigger for you. the one that we were just looking at that he funded that deal on. This is the numbers for his policy. So what we're going to do is we're actually going to look at the spread that we were talking about. And this is where Maureen, just unmute yourself and we'll do this. So let me grab a pen here and I'm going to draw as we do this. So right here, Devin, year one. Now I want to be clear. The first year that Devin puts money in his policy is the worst year because he's not going to make anything. Now, if that's something you can't accept, that you put 125 in and you only have 116,000 available, this isn't for you. Okay, keep your money in the bank, and we'll send you a special sign that says I'm with we do it. It says I'm with stupid, or money problem is what we like to say, because you're one of the rare ones that puts money in your bank account, and before the end of the year you go back into the bank to get a dumb sucker and take all your money out of the bank just to say you could do it. Because I don't know many people that put 125,000 in their bank and before the end of the year are like, oh my God, I only had 116 that I could use. No, you don't even touch the money in the bank in most cases. So that's the worst year. So he's a negative ROI in the first year. So he's got a negative return. Okay. So again, I'm just kind of eliminating part of the audience here and saying, if that is something you can't live with, I want to be clear. This concept will not work for you. But then
Chris, can you zoom in on that? Can you zoom in? It's really hard to see.
Is it really? Yeah, hang on. I did zoom in on it. Let's see here. Clear. Boom. And just let me know when it's big enough. How's that? Oh,
Yeah, that's good. You just slide it over.
that's what I'm trying.
Yeah, there you go. Just slide it over.
I know I'm trying. There we go. That big? Bigger?
Maybe a little more. There you go. There you go. Right there. Perfect.
All right.
There we go.
Sorry, folks. It was huge on my screen, so I assumed you guys were looking at it the same way I was. All right,
Perfect.
back at it. So year number 2. So, and also too, let's be clear about something. Devin puts 125 in. Devin takes most of all of this out, right, Devin? You don't leave much in your policy, do you?
No, he doesn't.
Okay, he does.
No, I was on mute. Sorry.
That's okay.
Yeah, I take it out as soon as it's there. Start using
And
it.
everybody should already know this, but if you put 125 in and at the end of the year or sometime in that year, he takes almost all of this 116 out, did he interrupt his compounding effect? In the chat, can any of you give the answer? If he had 125, and let's just say he takes 100 of that 125 out, right? So we got 100 he takes out. How much is left? Most people would say 25,000 because they're just used to that number. Wow, my drawing skills are terrible. That's supposed to be 100, just so you know. Most people would say there's only 25 because that's how your bank would work. That's how your investment account would work, your brokerage would work, and your crypto account would work. But here, the 100 he took out didn't come from his money. It came from his death benefit. The insurance company lent him his death benefit. So he's got 125,000 over here earning 6% gross with dividend. So that's the thing. So why would you ever leave this money in the account? Well, I don't know. Either you don't know how this works or you just don't have a place to move it to make more money. So that would be the only excuse. So second year, he puts 125 in, and now he has the access to take 124. Again, a negative ROI. He's losing money. That sucks. But he already took 100 out the first year, and then this year he's got 124 he can take out. So let's just assume he takes another 124 out. So he's pretty much taken the majority of all of his money out, but he's earning interest still on $250,000. But the third year is where the magic happens. And we build plans that it doesn't even take 3 years, but because there was no dump in, his is just, his is the regular plan where when you're not putting a dump in, usually it's going to be a 3 to 4 year efficiency zone. So you can see in the third year, he puts 125 in and he's got 130. Now this is where I need you, Maureen. If you could, Maureen, could you subtract 130,648, which is his cash value in year 3? Or I'm sorry. Do it over here, this one, 371,665, and subtract 241,017. So all we're doing, folks, is we're taking his cash value and we're subtracting year 3 from year 2. That's all we're doing right now. What is the number?
130,648.
130,648. Okay. So now we'll just leave it at that. 130,600. I'm just going to leave it at that because I don't have a mouse, so this is really difficult. 130,600. What I'd like you to do is take and subtract 136. So everybody sees that, right? Everybody sees how we did that. That's this number right here. I just wanted you to see how we got the math so you guys understand this. I know that's elementary, but this number here, the 136.48, is a subtraction of this minus this. That's all this is. Now, Maureen, what I'd like you to do is subtract 136.48 from 125.
$5,648.
Yeah, simple math. All of you could have probably just done that without a calculator, but I want you to practice using a calculator so that you get this down. So $5,648 is his true net gain. So what do I mean by net gain? Well, Devin, this policy has a $7.6 million death benefit. So if Devin's out cruising around and he's driving a fast car and he decides to take the turn just a little faster than his SQ5 will take the turn, and he doesn't end up, he goes to a better place. His family's getting $7.6 million. Now, how many of you think that the insurance company gives $7.6 million of death benefit for free? I think you all know there's a cost to that, right? So there is a cost for that $7 million death benefit in Devin's policy. Not only that, the insurance company charges Devin a nasty policy service fee of $50 whole every single year. So that's $50 extra on top of the cost of that $7.6 million death benefit. So now after he pays for the $7.6 million in death benefit, and yes, that's a cost. Yes, you guys can be like, oh, that's expensive. Maybe, maybe not. And after he pays that nasty $50 policy service fee that Mass Mutual charges him, he made in the third year $5,648 net. Okay. Now, Maureen, if you could take $5,648 and you could divide that into his investment, or it's not an investment, but his premium deposit that year of 125. Because remember, each year, folks, we're taking the money out. So we're only going to calculate a return based on that year's cash on cash. So 5,648 divided into 125. What was his rate of return in the third year?
45,184.
45%?
What was it?
No,
Maybe I did it wrong. Give me
Yeah,
the
yeah.
numbers again.
Here. So what we're going to do is we're going to take just his true net gain. Okay. So that is $5,648. So we're going to take the 5,648 and we're going to divide that into the amount of his deposit that year, which is how much? 125. Okay. So if we do that, divide it into 125, you didn't do the math wrong. We got to move the decimal over. His cash on cash return that year was 4.5%. Okay. So he made 4.5% net on his money that year. So now most of you are probably still not super pumped that that's a great return. All right, well, let's go one more year. Maureen, one more, and then we'll kind of move on. 134,226 minus 125 is how much?
$9,226.
$226. Now, again, folks, and I don't mean to keep beating this, but remember each year that he puts money in, he's taking that money out and it's working for him. So every single year, you saw the returns. Every single year, this money that he puts in is out there working if he's lending it to his company at 15%. Just want to be crystal clear that all that money is making money somewhere else right now. All I'm showing you is the internal rate of return, which was about let's just call it 4%. Okay. So here was 4% positive net. But this year, now he's got a return of 9,226. And we're going to take that net return and we're going to divide it into the amount he deposited that year, which is 125. And our return is now 7%. It's actually 7.3. So if you were all doing the math, 7.3 minus 5% borrow, his true net is 2.3. God, this is tough. 2.3%. How many of you are making 2.3% in your bank account? How many of you are making 2.3% in your brokerage account after you take all the money out? How many of you are making 2.3% on your crypto account when you took all the money out? I think you guys all see the pattern. None of you, because none of that even exists. Everybody that sees that and says that doesn't exist, that sounds too good to be true, that I could put money into something, take that money out and still make 2.3%, even though I took all the money out. Folks, like if that resonates at all, that is the sole reason why we do this. That is the single-handedly the most important reason, that spread. And if I kept doing those numbers, I just don't want to waste a bunch of time. If I kept doing that every single year for the rest of Devin's life, what happens to that number that I just did? Does it go up? Does it stay the same? Or does it go down? Can anyone answer that? Up, down, or same? For the rest of his life, there's only one thing that is humanly possible in that equation. That is right, David, up. There's not a day in Devin's life, my life, Steven's life, Maureen's life, or any of your lives, once you start doing this, that your money will ever make less than it did the year before. It's physically impossible because it is what Albert Einstein calls the eighth wonder of the world, which is compound interest. The one thing that Albert Einstein didn't talk about is uninterrupted compound interest, which now gives us the ability to not only tap into compound interest, the eighth wonder of the world, but then it allows us to then go out and make money a second time, a third time, a fourth time, a fifth time, a sixth time. We went 4 deep with Devin's example, but he could go further. As you start compounding money and it starts building, you have new problems that exist in your life. Those new problems are, where is your money going to go to work for you next year? And then where's your money going to go to work for you the year after that? Now, all of you are like, oh, that wouldn't be a problem. I'd find a place for that money to go. Careful what you wish for, because I can promise you eventually you do start kind of running out of places for that money to go. I had money sitting in my CV line of credit. It was a little over 30 grand and it drove me nuts. I had nowhere for it to go. Luckily, I had a Chris Rude deal come across. I'm like, boom, I'm jumping in on this. So then I get another one of those bill pay checks for $300. Actually, Chris Root still writes checks. So I just got it the other day. It came in the mail and I held it. And I showed my daughter. I was like, Vivi, look at this. That's daddy's money out to work. Those little green marching dollars, look at what they just did. $300. Mommy's going to go spend that on a pair of those sneakers that you're wearing, which I have no idea why you're wearing Gucci sneakers. You're 20 months old, but sometimes, happy wife, happy life. She'll resell them on Poshmark, folks. Don't judge. She's very good about that. She buys nice stuff, but then she resells it when Vivi grows out of it. But anyway, you get the point. Like, it's just $300. Most people are like, that's no big deal. Well, yeah, but you never asked how many $300 checks I have coming in from my money working. All right. What do you got? Any other questions here?
Is Devin funding it annually? Or are you breaking it up monthly or quarterly, anything like that?
Great question. So you guys can do it however you want. It can be monthly, quarterly, semi-annually, or annually. I do annually because it grows faster. If you think of like 12,000 a year, if you put that all in at once, you're getting compound growth off 12,000 from day one all the way through to the end of the year. If you do monthly, you're getting compound growth on $1,000 the first month, second month, $2,000, third month, 3,000. So it just grows slower. So personally, I just dump it in, forget about it, and start using the money. And one thing I want to touch on too, because Chris had that up with that illustration, is
Going to pull it back up?
if you could, yeah. Is just when you look at these things, the biggest thing I had to do and I had to wrap my mind around is that wealth is, it's a marathon. It's not a sprint. No one gets wealthy overnight. Some people get rich overnight, win the lottery, things like that. But how many of them are broke a few years later? Wealth is something that it takes a long time to create. So when you look at policies, you have to have long-term vision. You have to think several years down the road. So like this policy at year 13, let's call it, I would be 40. When did we do this policy? This was when I was 35, I think. So I'd be 48. Right. So if we do the cash on cash return at that time, it's ridiculous. But here's the thing. This is just the internal rate of return. This does not include me feeding, remember, 15% interest. I'm feeding to my policy monthly. That means I'm putting a hell of a lot more money in the policy. So these numbers get ridiculous when you really start looking at how you're using it. If you're buying your cars through policies, which I have an Audi that I bought from the policy, and then I leased it to my business. So my business writes a payment to me every single month as a lease payment. So I have a tax deduction. That payment goes back into my policy. And I think it's at 5%. So that's, again, 5% more on top of the 15 I'm feeding it. So these numbers are just if I put money in the policy and leave it, don't do a thing. But as you all know, that's not what a policy is built for. It's built to use. So I wish there was some way, Chris, where we could actually have an illustration drawn up like this to show with how I use the policy, how these numbers would actually look.
Yeah, I
That would
mean,
be, that would be cool.
that would be, and we probably have that in our mapping team. It's just when you get a wall of numbers up, people just glaze over sometimes because, you know, that's what it is. It's really just money compounding on top of money, compounding on top of money. But I mean, right here, this is pretty easy to see. I mean, you put 50 grand in the 13th year, all the other money that you've ever put into the policy, because everybody's mind wants to go to the way that they look at their investment account. Yeah, but over from year 1 to 13, he put in X amount and he's only got this. That's terrible. No, every year his money's been out there working. Like you can't even it's kind of like thinking about the government in their debt. You can't even comprehend like that amount of money. Well, here, every year his money's out there working, making, and we're not showing what his money working for him is making here. We're simply just showing you the stupid machine, the whole life policy. That's all this is. And his cash on cash return, if you guys do the math, remember how to do it. Year 13, he puts 50 in. Year 13, that 50 makes him 117,721. But that's not really an accurate way to say it because it's not the 50 that's making him 117. It's the uninterrupted compound interest of every dollar he's ever put into the policy that makes 117. But that would be the equivalent of him walking into the bank, depositing 50 grand, going back at the end of the year and saying, hey, how much money's in my account? And the banker telling him, well, your account today has 117,721, but tomorrow it'll have more. And then he takes that 117,721, subtracts out the amount he put in that year of 50 grand. That's 135, let's see, 135.442% cash on cash return. Do any of you really give two shits that you got to give 5% of that 135% back to the insurance company? Do you see like how short-sighted too many people are? A lot of people, this is a very smart group, but a lot of times we'll have people on here that will be like, yeah, but why would I pay
Hold on
my
a second, Trey.
I don't want to pay the insurance company 5%. Yet again, if you made 135% on your money that year,
Okay,
really be upset if you gave,
that was short.
whoop, somebody's got to mute. Would you really give a crap about giving 5% back to the insurance company? You would not. You wouldn't even think about it. You'd be like, yeah, here you go. No problem. Enjoy.
Mm-hmm.
Yeah. And that's a tax write-off too, guys. The 5% you pay is a tax write-off. So
Mm-hmm.
that
You
135,
got to mute.
that,
That's
I don't know
me.
who that is. I don't know who this is. Marine on here. I'm gonna
Oh, I don't know.
change to attendee. I don't know who that is.
Okay.
Go ahead. We're good.
but yeah, that 135, guys, that's just the internal rate of return. So that is literally just if I put money in and don't touch it. I had a real estate deal I did last year as a flip, and my rate of return cash on cash with that deal was 31,000% because I used this policy. That's not including the internal rate of return. So if I would have done that same exact deal in year 13, when I make 134% plus 31,000, the rate of return cash on cash in that deal would have been astronomical. So it's all about how you use the policy. I tell people all the time that this policy is amazing if you know how to use it. If you don't know how to use it, it's kind of useless. It's like if you had a really tricked out Ferrari that's a stick shift, but you can't drive stick shift. It's an amazing car. It looks incredible, but if you can't drive it, what use is it?
I have the answer for that. If you have one of those Ferraris, it's a stick shift, but you can't drive, just call me. Just call me. I'll come over. We'll go for some runs. You can just let me borrow it, and then I'll make sure it gets used, and I'll even wash it.
There you go. Yeah, it's all about the use, guys. You have to know how to use the policies, and once you learn how to use them, they're really simple, actually. Again, I always go back to it. It's just a spread. How can I make a spread? That's all you got to think about is like, if I use the money for this, what's the spread going to be? And if it's not a good spread, then find a different use for it. As long as you're making a spread, you are doing what banks do. Banks make a spread on your money. So why don't you just make a spread on your money? And it's super simple. All you got to do is just put the money in the bank and then use it for things that you already use money for. Just make a spread on that money.
Absolutely. All right, Stephen, what other questions we got going on here? I saw a couple come in.
Yeah. What happened there? Drew saying, when you say you're feeding 15% into your policy, you are only paying off the loan and the spread is in the separate bank account, right?
That's correct.
Good question. I actually don't let money sit in the segregated account. I immediately feed it back into the policy, because when you're paying into the policy, you're paying down a policy loan, and the policy loan is simple interest. So you're just paying interest on the balance. So the lower the balance goes, the lower the interest paid. So that widens my spread. So if I just let the money sit in the segregated account and build up in there, I'm not lowering the balance of the policy loan. So the spread is not going to get widened. You know what I mean? So that's all I look at, is how can I widen this spread of money? And the way I do it is, once I pay myself, it goes directly back into the policy.
Yeah, and just to keep going on that, Drew, because I know where you're going with that, he doesn't leave the money in the policy long enough for it to ever fill up to where he would mech it, or where it doesn't hold anymore, because he's immediately pulling it right back out of the policy for the next deal. Now, if you just quit real estate, then then the money would sit in the segregated account, but that ain't going to happen. So there's no problem with it. He's just constantly moving it.
Yeah. I let it build up usually to 25, 30 grand, and then I'll lend it again. I just don't want to have too many loans out there to myself, like one for 25, one for 30, one for 15, one for 50. So what I do is I'll let it build up. I'll lend to my business. And then when I get too many loans, I'll pay them off to myself. And then all that money goes into the segregated account. And then I lend at a big amount. So I'll lend like 295 grand at one time. That was 8 or 9 loans to myself. I just consolidate them. I am literally doing what banks do, consolidating debt, right? There's consolidation loans. Same thing. I'm just doing that same thing with my banking system.
Mm-hmm. Yeah. So one other one, you have all these owned personally, Devin? You don't have any owned by your company, do you?
The policies?
Yes.
Yeah, they are all individually owned. I do that because I can then lend the money to the business. If it's a corporate owned policy, the money would go from the policy to the corporate bank account. So now I can't lend from the corporate account to the corporate account. Wouldn't make sense. So that's part of the reason I do only individual policies, so I can lend to the LLC and create that spread right out of the gates and just funnel the money back through.
Yeah.
All right, great. And we're getting towards the end here. I just want to mention one thing. We do have the money multiplier. Brent and Hannah are putting on a mastermind in Daytona Beach coming up in May. So I'm going to put the link in the chat box. It's $97, and it has food for the whole weekend, dinner at Brent's house the first night, and 2 full days of education. And it's not a mastermind where like the experience is, for those of you related to the one that Chris and our team puts on. This is purely educational. So this is classroom style. Devin will be there speaking in person on these strategies. I'll be there. Chris will be there. Our whole team will be there, and Maureen will be there. So join us in Daytona Beach in May if you like this kind of strategies and this more advanced stuff. So we're super excited to do this again in person. It's been a couple of years because of COVID. We were doing it virtually. So back in person, Daytona Beach, and one of the nights will be at Brent's house. So it's going to be a really awesome event. I just put the comment over in the list. So make sure you get a seat. It will sell out.
Yeah, it definitely will sell out. It's a ton of fun. I mean, you guys remember, I don't remember how many seats we have available. Do you know, Stephen, how many do we have?
I think she said 150, maybe. 150. I don't know. It's not many though for what it is.
If we just do the math, we have over 4,500 clients and we can only hold 150. So don't wait on that. It's not like it's not an expensive event. I mean, yeah, you got to get to Daytona Beach, but you know, it's a great time and we'll all have a lot of fun. So make sure you guys go there. Drew, you better get your plane ticket now. I'm watching you, buddy. You better get that plane ticket right now.
It's a beautiful resort on the beach. So if you have kids or anything like that, bring them. They can hang out at the resort.
Yeah, for sure.
Oh, sorry, Chris, I was freezing up there.
Oh, that's okay. We got any other questions? And then I just wanted to show one other thing, you know, just to kind of give it, you know, a lot of people always ask about the loans to your company. I mean, it's very simple. If you guys can see this is a note. This is one loan. I just did this a couple days ago, February 10th. I have a flip going on. I can't believe I did another one, but 881 Klein. I partnered in this deal with another gentleman who funded the purchase of the property. I found the deal. He funded the purchase and I'm funding the rehab. So this is a $45,000 loan at 6% to my company. So I lent the money to LC Strategic Realty from me personally. And then I put my policy number on there that I lent from. And then all I'm doing is every month I set up a bill pay for $225 a month. The first check will show up March 10th. This is like Devin's tickler file. He knows what days. Well, that's the day this one shows up. And then I also did this one which is the copy machine out there. We finally got the bill for it. It was $8,234. Now this one I did different. This is it. The first one, the rehab loan for 45 grand. This is interest only. Okay. This one is interest plus principal, and it's for $82,34.89, which was the exact cost for the copy machine out there. This will generate a payment of $193.40. Now that payment I didn't come up with. That payment came from how much the copy machine company was going to charge us to lease that machine. So all I did is I reverse engineered it. I went to bankrate.com, folks, and I just reverse engineered the loan. There's bankrate.com. And it just said, based on a 4-year loan, 48 months, 6% interest rate, $193.40. Total principal paid back, $8,235. So I will make for buying a copy machine. Now, I don't know if any of you can ever say this, but I bought a copy machine for $8,000 and I will make $1,048.15 in 4 years without selling the copy machine. If I sell the copy machine to someone, that's money on top. Like, how many of you can say that you buy something and you get all the money back plus you make interest on it?
Hey,
Probably can't, because you got to be, yeah, Steven and Devin and Maureen, you know, and I'm sure a bunch of, you know, Colleen and, you know, Brian and a few of the other people on here that have been on this journey. But like, that's so stupid, right? A lot of people are like, well, how do I make money? I don't know where to make my money work. I don't know. Do you have a business? You need a copy machine? Like, how stupid is that? But how smart is that? I didn't do anything difficult there. I looked at how much the copy machine would have been to lease. And all I did is I just reverse engineered it and paid that amount to my bank. Everything else is identical. Not a penny more is being spent, except for I'm in control. I make the interest instead of giving the interest to some leasing company. Most people would just be like, oh, I got a copy machine. Yeah, we just lease it. I don't know. I don't want to deal with it. Well, I have a service agreement built into that price as well. I mean, like, it's just silly how simple this stuff becomes when you start really thinking about all the things that you're using someone else's bank for on a day in and day out basis. It doesn't have to be complicated. You know, Devin's is like a high level, you know, very advanced strategy. Buying a copy machine, going to bankrate.com, not very hard. You know, lending 45 grand to my LLC to fund the rehab on a property, not very hard. This is very simple stuff, folks. And it just starts with changing one thing. That's it. Literally everything that you've heard me, Devin, Maureen, and Steven talk about today involves one change in your life. That is it. And that is where your money goes first. That's it. The mapping team will take care of helping you structure all this. Like, I've got maps built for these that I didn't do. I just called the mapping team the same way Maureen would, the same way Devin would, the same way all of you would. Jonah, hey man, I'm doing a loan for 45 grand. Can you throw that into my map? Cool. All right. When can you get that? All right, great. Thanks, man. Done. I don't know.
Yeah, it's pretty easy. You just got to think about things that you actually borrow money for generally. Like, that's what you would use the policy for if you're not going to use it to invest. And people borrow money for all kinds of things, right? I think about my daughter. She's getting braces right now. And the orthodontist gave 2 options. They gave an option to pay in full, or they gave an option to do payment plan. The payment plan was more expensive. So what I did is I just paid in full using a policy loan. And then I took whatever the payment plan would have been, which ended up being like, I think it's $1,200 more over the time frame. And instead of paying them that, I'm just paying myself that. It's really simple. It's just, you just have to do it. Once you do it, it's easy. It's like if you're riding a bike, if someone explained how to ride a bike, it would sound kind of confusing. But if you just get on the bike, you fall a couple of times, then you know how to ride a bike for the rest of your life. You could not ride a bike for 10, 15 years, get on it very easily and ride the bike. So it's just getting in the game, using the policies. I've only been doing it for a year and 9 months, and I use it for everything. So not hard, just you got to do it.
Yeah, and
be like Nike and just do it.
Just do it. And actually, you know what? Another thing I want all of you to do real quick, and maybe Steven can find it quick and put it in before we close out. I want you all to go to YouTube and watch a video, and just in the YouTube search, just put in backward bicycle. Backward bicycle. We'll try to put it in the chat here, but you can just Google backward bicycle or put it in the YouTube. Watch that video. Everything we do is the exact same thing as that video describes about a man who was challenged to ride a backward bicycle and he couldn't. And he practiced and practiced and practiced. And he got so good at riding the backward bicycle that he couldn't go back and ride a regular bicycle anymore. When you start becoming your own bank, when you start doing what we've said, it will be very difficult for you to go back to the way you do things today, to the point where you will look at your friends, your family, and you'll be like, are you all bloody idiots? You will have a very difficult time having normal conversations with people about, the way they buy their cars, the way they finance the things in their life, the way that they make money. You'll literally sit there and you'll want to help them all, and they will never understand this because they haven't taken the time you have to learn how to ride the backward bicycle. I always tell people, and just the other day, another example, I am done helping friends and family. I just can't do it anymore. I don't mean to be selfish, but I just can't, because they don't take it serious. They don't put the time in. They don't do what Devin did and watch a 90-minute video to learn how this works. They simply expect everything to be, as Maureen said, easy peasy. It is, but first you got to learn how to ride the backward bicycle. Then it's easy peasy. If you don't want to put the time and energy in to learn to ride the backward bicycle, i.e. be your own bank, this is going to be a difficult ride, and you might as well just stay on the path you are, which we call the financial hamster wheel. So go get yourself a hamster and watch it every day. That's what you're doing in life. You are literally running and running and running and running and getting nowhere. And that's because your money isn't working for you and you are not in control. When that hamster gets off that wheel, because it just one day learns, hey man, all I had to do is change one thing and go right. He's off the wheel. That son of a bitch is gone. You ever see a hamster run? Little buggers are fast. All right. Anything else, Stephen? What else we got to close this thing out?
Yeah, I mean, I think we're pretty good. If anybody has, there's a few little questions in here. Devin, did you say use one policy to pay off your monthly expenses also?
Yeah, I do that with everything. So I'll use credit cards. I've got like 12 credit cards. It's kind of silly. This is off topic, but the reason I have so many credit cards is if things like hit the fan and the credit card companies slash limits, I think I'm at like $350,000 worth of available credit. So let's say they slash it in half. I've still got 175 grand of leverage. So I highly recommend you guys go get credit cards, get leverage. Don't go be stupid and buy things on them that you can't afford, but it's good to have them in case things happen. So off topic, but that's why I did that. But what I'll do is I'll take credit cards and I'll cycle them through my wallet because it only holds so many. So I'll do like 2 a month. I'll use those throughout the month for everything, gas, food, any expenses I have for the month. At the end of the month, I just take money from my policy and pay them off. So now I'm using money that's never going to stop growing. Instead of paying the credit cards off from a regular bank account, then that money's gone forever. It'll never make me money again. So I take the money from the policy, pay off the credit cards. Now I'm not paying any interest to the credit card companies, and I'm getting flyer miles, points, cash back. I'm basically getting paid to use my credit cards, and I'm using money to pay them off that'll never stop growing for me for the rest of my life. I just cycle money back through it. So I treat paying that off as if I had a credit card payment still. So I'll make like a $500 payment each month back to my policy as if I'm the credit card company. So
I like it.
Yep. And the last one, when you're establishing the loan between you and your business, is there an agreement template you recommend using? That was that promissory note that Chris was showing. So it doesn't have to be anything special, just a promissory note.
4 pages, and you could do it with a 1 page. This is just a standard note. Go on Google and Google promissory note template. And, you could use that or call your attorney like I did and have them draft a note. I use the same note for my company as I do for, if I was lending money to Devin, I'd make him sign this same note. It's just the terms. That's it.
Yeah, I use the same one. It's like a 1-pager. All my private lenders, they sign that, and then I just do the same one of myself. So just Google promissory note. That's how you can get it.
So folks, listen, like we covered a lot of ground. I know it was, that's why we had Stephen do Stephen wanted to, he did the presentation yesterday. It was phenomenal. A lot of you saw that because, today we knew we were going to be advanced and we wanted to make sure that you were ready so that you would watch the 90-minute video. If you missed last night and this was all kind of Greek to you, we have a 90-minute video that teaches this entire thing. And right now, for the first time, we are going to be launching a 23-minute video, which hopefully will obtain a lot of the same things that the 90-minute does. For those of you that are too lazy to sit down and watch a 90-minute, we'll have a 23-minute video soon. But for right now, watch the 90-minute video. Watch the backward bicycle video, and then book a call with us to basically answer your questions that you have about how this would work for you.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Click that alert button, actually smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.